All right guys, part 2 of volume and delta, we're going to cover delta. We're going to look at this as a way of sort of an advancement on volume, because volume is helpful after the fact and it's helpful in terms of being able to confirm things, but you want a little bit more detail, and this is what delta gives you, because what it gives you is how the volume is being created. And that's a whole new world of information, because now you start to see whether this volume is being created by people actively pushing the market in one direction, or whether it's buying that is running into a brick wall. So you can then relate what is happening price-wise with how the volume is then changing. And that gives you a whole new understanding of specifically where things can change and also how people are getting themselves positioned. So let's go start off and we'll start covering delta. So this is about understanding the activity of buyers and sellers. So not just about relative volume and how volume has changed over a period of time, but it's about understanding the relative action between who's doing the buying and who's doing the selling. So ultimately what delta gives you is it gives you the net number of buys at market versus the net number of sells, or it gives you a total net by giving you a number of buys at market versus the number of sells at market. So what you're trying to see here is who is active, who is going and meeting the price, if you will. So for example, if I say, right, I want to sell at 72 and somebody says, okay, great, and buys, they're the one who's active. I've done nothing, I've just set the price I'm willing to sell at. The active trade is the person who says, yeah, I will pay that price, and they hit market and buy it. That's what you're trying to understand. Who's got the sort of aggressive action versus the passive action. And this is why it's an advancement of volume, because volume doesn't show how that's been created. Volume will just give you a total number, whereas delta gives you so much more information. What we've got here is a footprint, and we'll come on to footprint when we do order flow. But this gives a good illustration of how exactly delta gets created. What a footprint shows you is the volume traded in terms of number of sells at that price versus number of buys at that price over that period of time. So we're looking just here at this little dark green area with a lighter red next to it. What this is showing you is that you have had 110 sells at market at that price. You've had 36 buys at market. So 36 times someone has lifted the offer, 110 times somebody has hit into the bid. So this gives you a negative delta of 74, 110 minus 36. Total volume here, of course, is going to be 146. So the volume at price gives you 146, and that may not be particularly significant. You'll then start to see that there is acceptance building here, because you look at these two blocks next to each other, and twice you see a significant number of sells into the bid, and price doesn't seem to go anywhere. So volume is going to increase there. You'll see volume at price increase significantly. Volume on those candlesticks will have grown. But from a candlestick perspective, the volume has grown throughout this period. Now you don't know where that volume has happened. Delta helps you understand that. And in particular, footprint helps you understand the specific prices that that's happened. We're going to concern ourselves in this instance with looking at cumulative delta and how that shifts, and how the shift in cumulative delta relative to price gives you indication. So what we're seeing here and what you're trying to infer from delta is who's got the strength. So rather than just using volume to infer strength, you're seeing whether that strength is actually sustained. What's happening here then is that you're getting a lot of selling, but this is clearly running into a wall of buyers. Buyers are happy to sit there and buy and buy. Yeah, anybody who comes and sells to them, buyer comes back and gives them more. So this is showing you not just that there's a willingness for people to sell, but that you're seeing this very clear, distinct battle between willingness to sell and where the buyers are stepping in. So this gives you a negative delta, which doesn't on its own mean that the market has to go down or has to go up. But this has relevance dependent upon context, dependent upon where exactly this is happening. So that's what delta shows you in the sort of micro price by price. What we're looking to try and do, using a cumulative delta indicator, is understand a few different things. First up, we're going to look at divergence. So this is a scenario where delta moves counter to price. Price moving down, delta moving up, for example. And how this can then be used to indicate a change, how this can then be used as a method to step away from trade, to play reversal type trades, and we'll use it in conjunction as well with chart patterns. Because ultimately any indicator is there to enhance your understanding of something that you're already looking at. Confirmation, much like volume, what you're using here then is delta increasing with a move as an indication there is still a willingness of people to buy. And so as long as you're seeing them price and delta going together, you can assume that the move is still alive. Even if you're seeing that volume is beginning to fade, the fact that people are still willing to drive that move is still indicating that the move is alive. Also initiative, and this is what volume won't help you with. Volume's very difficult to be able to notice as it's happening, whereas delta's a little bit easier. So whilst you can see volume increasing within a range, and this can be used to give you a clue as to the break, typically the volume within a range may also be created on the part of the candle that breaks the range. And so therefore, you don't actually see the volume increase until the volume has increased, if you will. Whereas with delta, you can kind of see the delta picking up earlier on. You see that what I call a delta punch. You see this punch in delta. I'll give you a good illustration of this in a moment. That shows the initiative. It shows that buyers or sellers have now stepped in and they're going to become active in that range. They're going to drive the price out of the range. That's what you're looking for. And we'll also go finally onto a longer time frame and look at how it illustrates positioning over a larger period of time. So using your delta rather than an enhancement of an already established technical trade that you're looking for, using instead your delta as a way of understanding positioning over a period of time and how that's then going to potentially initiate movement. Right then, so we know what we're going to use it for. One thing that I've not used as an example so far is something that I've done in the past, and this is where I learned about delta, and so many lessons come from mistakes. So I'll talk you through this one. Because by breaking down your mistakes, you start to learn not just what you did wrong, of course, you start to learn how to avoid that in future. You also potentially can turn this round into a trade. And the first thing that we're going to touch on after this is delta divergence, and this is something that came directly from a losing trade and something that then developed by turning that trade over and saying to yourself, okay, well, how can I turn this losing trade into an advantage? How can I turn this into a winner? By doing that and understanding what had gone wrong, you can then understand how you can make something out of it. So, I'll talk you through the trade. So there's a lot of information on this, and yeah, this came from a debrief of mine, and this was from around about the back end of 2016. So before I actually came over to Axia. But the point being, this is how I learned it. And what's happened here? I came into this day thinking, right, I won't talk too much about profile, but what I'd seen on the previous day is that we had had a breakout to the upside that had completely failed. The close on the day is down here. So essentially you had broken the previous day's highs up at 10,744, broken higher and then closed back inside range. This to me was a pretty solid bearish signal. So I thought, right, overall there's an opportunity. My aim then on the day was that if I could sell, and I'm not going to talk too much about the profile, but if I could sell between the close and the VPOC, so around about a 10 tick range on the DAX, if I could sell somewhere in here, I've got the opportunity of playing this to the downside and there's a potential trend move down because you've had this failed break. So I got a bit of a plan there. Yeah, that was one of the ideas that I was looking for. Now what happened, and part of what I learned was not just the technical aspect, but an understanding of my own kind of frustration with the trade. What happened on the day is we opened with a gap down. So my intent to sell up here between 25 and 35 was not realized. Market opens at 10 and starts to drop. And that's this move just here. So market starts to drop. This is frustrating. I'm not in the move. I can see the trade that I was looking for running away from me. So as the market falls, I start thinking, okay, well, we'll wait and see what happens and then potentially get into this in a moment. So market then starts to fall. An hour or so later, we've continued to fall. Opportunity has not been great to get into the trade, and we're now 60 to 70 ticks lower. And I'm quite frustrated, the opportunity's gone. I know though, that there is a piece of data coming out, German data, ZEW data, coming out at around about 9:30. And my thought was, and this was my then adapted trade plan at the time, I thought to myself, okay, data's coming out. If this comes negative, we're already in a bearish move in a market that has got potential bearish setup. I'm going to sell this. Anything negative, this is a sell. So data comes out, small miss, perfect, just what I'm after, chance to sell. And my plan is to sell it somewhere down here for the continuation of the move. And what happens is you end up with this huge reversal move. I get trapped, it costs me a fair bit of money, huge amount of frustration because not only have I missed the move that I was looking for to sell this part of the move, I have also lost as the market bounces back up, and it bounces back up exactly to where I want to sell it. So huge amount of frustration. These are the kind of trades where you look at and you walk away and you say to yourself, or you almost don't say to yourself, you say to yourself, forget that, I'm not thinking about that again because I don't really want to, because it's a bad experience. But I was frustrated and thought, well, I need to work on this. I need to work out what happened. I spoke to a mate of mine next to me who said, well, do you see the delta on that? I said, no, I don't have delta on my charts. And what he was saying to me, or what he'd said to me, was that throughout this move, delta was actually rising. So going back to what delta shows you, rising delta is showing you that buyers are actually more active. Buyers are lifting offers. So as that's happening, this is an indication that actually the strength of the buyers here. Sellers are not particularly strong. Sellers are just passive. They're waiting to get filled. And when the market doesn't bounce and buyers run out, or buyers start to disappear, market starts to fall, same process again. So he said his view was that, well, people essentially are buying this, and sellers, the moment they step out the way, are in trouble. The ZEW number that comes out down here, that was a miss, was a prime chance for sellers to become active. This was the chance. If people wanted to sell, they should come in and sell it now. The fact that they don't is a strong indication that sellers really aren't very strong in this move. And the sellers who have sat there and passively accumulated on the way down by waiting for the active buyers to hit them, now are forced to get out because they don't get the continuation move thereafter. And that's why you get this very fast reversal. So that to me then was a reason to start thinking, right, I don't need to be on this trade again. If I start to see this type of grinding move down where delta in fact is rising, I can start looking at this, one, as a point to not trade, or certainly not trade short, and two, look for a potential reversal. Look for something like this. That's where the opportunity is, the trapped positions. The people like myself who made that mistake down here, got themselves trapped short and contributed to this charge towards the upside. So that's how I learned about it. And some of the biggest lessons that you're ever going to learn come from your losses. So don't ever dismiss a loss. Don't ever look at a loss and think, don't want to think about that again. Ignore it. There's probably something to learn. And because they stick in your head, those losses, it's a much easier lesson to learn as well than looking at a winner and think to yourself, that was good. Because it's easy to look at that, say, right, that's good, I did well, and we'll move on. So don't dismiss losses. Okay, so what exactly is happening there? So I kind of quickly moved through that piece. What exactly is going on? How does the trade work? So this is a delta divergent trade. What essentially you're getting is, in this instance, a move down, and this is a different move, a move down where you're getting more buying than sellers, more buying than selling. So what we've got here, candlesticks on the way down, this is your delta. Now, the three circles that you've got down at the lows match these three circles here. And what you notice quite clearly, delta is going up, price is going down. So what's going on? Well, to start with, the initial move down, sellers are strong. They initiate movement, they sell through any buyers, sellers take control. But once the move starts to stagnate into this kind of downward sloping wedge, things start to change. What's going on here then is sellers are no longer so keen to sell. Bearing in mind, the market has just now dropped from 75s down to 45s and is now continuing lower. So you run out of sellers who are going to keep driving this down. Instead, sellers step back and they put their orders, they put offers in instead. So they put their orders to sell rather than continue to hit market. Great. So what then happens is buyers start to lift those orders. They become a little bit more aggressive. Market just drops and they go, right, we'll start to buy here. Now, this is where I find that delta can become slightly confusing. Because what's going on is what you're seeing is sellers sitting on the offer, buyers buy into them, and they buy into them again. And what's happening is the sellers keep on coming back. And this is why delta rises, because they're continually giving the buyers the opportunity to buy, but price doesn't rise because sellers continue to reload. So delta rises. After a period, buyers realize that they can't get the price to go up, and so therefore step away. The buyers step back. It takes very little selling to then push the move down because you don't get buyers continuing to reload. As price drops, buyers will then come back in and try and buy again at lower prices. And that's what happens on each of these bounces. Buyers come in, and that's what creates the push back on the delta. So overall, you're seeing more and more buying. So what you're waiting for then is a situation where either the passive sellers, the people who continually put their offers in down here, become active and start to drive the price down, Or those sellers get out of the way and the buyers who clearly are more aggressive drive price up. Now, think of this from a seller's perspective. They can sit there and sell and they have no problem selling because every time someone puts an offer in, buyers are coming in and buying. So you have little incentive to drive price down. Whereas the buyers, if those sellers step out of the way, now they're already shown that they're active, that they're willing to pay higher prices. Now they're going to have to start to chase. And this is what creates the reversal type trade. So this is what you're waiting for. Once the sellers step out of the way, now you end up with a situation where, in fact, it's not just a case that you've already got buyers who come in throughout this period here, but all of these sellers are now getting put under pressure and they are going to have to be forced out of their trades. They also become buyers. So now all of a sudden, you've gone through a period where, yes, volume has fallen. So this could, to start with, be a good indication. So volume in conjunction with delta, the two are going to go hand in hand. Volume starts to fall, delta rises. You're seeing that during this period of falling volume, potential end of move, delta starting to rise, potential reversal. Now you're looking for your access. This is what's so key. I'll illustrate this in a moment, but without the access, this is a trade that is not you can't take this trade on. Because you could have a situation where delta continues to fall. Sorry, price continues to fall, delta continues to rise. You have no way of getting into that trade. So that's what you're looking for. That's the scenario, and that's what's happening. Once you get to the point where the reversal really starts, delta reverses completely. And so you get this full reversal. Delta drops from here, drops down, and then full reversal back up. This is my point on access though. Because what we have here, this is a move over a couple of days. This is a move in the euro dollar. What you can end up with is a situation where delta falls, but you never get a chance to sell this. And this is the danger of looking at falling delta, so a delta divergence, price rising, delta falling, and thinking, I'm going to sell this. Because like volume, all delta is there to do is to give you a clue. It's to enhance an already established idea. So an already established technical trade you're looking for, volume and delta is there to enhance your entry on it, enhance your willingness or ability to stay in a trade. It is not there to indicate you should take the trade. So in basic terms, the falling delta is a good indication this should be a sell. But the fact that price continues to rise is an indication clearly that you're wrong trying to sell. You're selling into buyers who continually reload the bids and then continue to raise those bids up. Once sellers run out, buyers push price up, sellers get out of the way, and buyers then increase the price of those bids. And the move continues up, delta continues to fall, price continues to rise. So you can want to sell this all you want, but unless you get the opportunity, a setup, a point where you can say, yes, now the reversal comes, you can't take the trade on, and this provides you no access. So you need a pattern, you need something to lean on. The delta is just helping you with that. It's helping you by saying, yes, you can lean on this, there's an opportunity, but you can't take it without that trigger point. So let's go and have a look at a couple of ways of accessing trades like this. What we've got here then, this is what I would call a very common divergence pattern. This is a situation where you end up with this wedge at the lows. A bit like the first couple that we looked at. You can end up with a flat bottomed wedge, you can end up with a downward sloping wedge, something like that. We know from when we looked at chart patterns that a pattern like this is an indication that essentially the move is running out. That the energy that was in here, the action that was going on in here is no longer sustained. As such, you already from the pattern are starting to think there's a possible reversal here. You then start to see delta rising. And after this first spike down, remember what we said about spikes in volume, good indication of end of move, particularly if volume relatively drops off very quickly, which is exactly what happens here. Huge delta spike, volume drops very quickly, move stagnates. Delta starts to rise. Now, that steady increase in delta should be saying to you there's potential reversal here. And you can start then to plan your trade out and not get sucked into, because the easy thing to get sucked into, and this is what creates that negative delta, is trying to sell a pullback. The people who see the move down and say to themselves, okay, I've missed this, let's get in on a pullback for the next leg. They're the ones who provide those passive offers. They're the ones who allow that delta to rise. So delta starts to rise. And that's all happening in here. But now you've got an access point. You can see that you have the downward sloping wedge as one place to get in, or you have the top of that wedge as your other place to get in, around about 13.43. So that comes in just here. There's your alternate access. So you have two options on this trade. Down here on the break of the wedge or on the break of 43. You've got a clear target. you've got the top of the liquidation candle, which is then reached a little while later. Don't expect these moves to suddenly, develop and immediately drive you on side. The moment you get filled, the moment you get in, you're going to instantly be on side. The reason for that is, as the market starts to bounce, people are still going to be willing to sell, as we talked about with wedges. That until you get beyond this point, we don't get this opening up of sellers being forced out. You end up with a situation where sellers kind of just steadily get out until there's a realization there is no further move to the downside. So that's a kind of typical type of delta reversal pattern. You're looking for the delta then after the build up within the pattern. Once it breaks, you're looking then for the delta to accelerate, which is exactly what you start to see here. This move up here, delta rises very quickly within it. That's your indication that the move is very much on, but you could well be in this way before. You want to be in somewhere in this range here, stop below the low, looking for the full reversal of that trade. So it's all about access. The delta gives you the clue. The delta says, yes, this is on. You've then got to find the way to get into the trade. And of course, no two trades are the same. If we go and look at this as an alternative, this is using a block reversal. So rather than this downward sloping wedge, which is, for me, been my kind of favorite method to get into the trade, ultimately it's about using the tools at your disposal. This setup, the block reversal, absolutely same principle. And you actually get a slightly different scenario here, where what's going on is rather than you seeing price falling and delta rising, instead price stabilizes and delta rises. So it's a slightly different situation. At the bottom of this spike down, which makes sense, you're breaking through previous lows, you get this spike down, 80s down to 55, nice quick move down. You're looking for continuation. Traders are going to look for continuation in here. As such, and the reason that you do get this delta starting to rise, passive sellers sit there and wait and try and sell on the pullback towards 59.25, looking for the next leg of the move down. When they don't get it, and you get the classic block reversal trade, spikes up, pull back, delta's already rising. You already know that buyers really are in control down here. And once the control translates into a technical break as well, now the move's on. Now you've got a clear way of defining stop. You've got a clear target back to where the move came from. You've got delta that supports it. And so whilst you have the lack of volume, because from a volume perspective, you wouldn't be massively interested until we start to get up here, where you get this spike of volume, which leaves a lot of the move behind, which leaves you ultimately getting in right towards the end of the initial kind of reversal move. So you're using the block reversal with the delta as your way of getting into this trade. It leaves you in a situation where you've actually managed to buy right at the bottom of a significant hourly spike candle. So you get right in at the bottom of the candle. By the time this candle closes, you're back up around about 80, so you're up here. And this is now your opportunity to play the continuation type of movement. So that's what's so key with delta. You get the move down on its own, on the initial move, you are getting clues that the move could be coming to an end. And like I've said before, this could be the end of move, it could continue. So you then need to assess what's happening in here to decide whether this is going to continue or not. The rising delta is a sign that this potentially isn't going to continue. And then once you get the break of the block above 59.25, this is your sign that the reversal is on. So the volume gives you a little bit of clue. The delta enhances that information. The block reversal gives you the entry to the trade, and you know the rest. Then you know that you're expecting a steady move back as people sell on the way back up. People are going to look at this within this move here and still see opportunity to sell. Once you get beyond the first resistance on the way back up, which comes in at 71.75, that's where the break towards the upside comes from. That's where the surge comes in volume, and that gives you this short-term spike up before then a continuation thereafter. Okay, another way that you want to be looking at delta is a method to preempt something, to preempt what's going on, to preempt entering a trade. Now, we've kind of already talked about this with the delta divergence, but this is using it to confirm something that you're already looking for. So rather than it be something that says the reversal is on, wait for a way of getting into this, you already know the trade here. You already know that there's an opportunity to play for a move up. So the idea of this trade then, we're trading in a range on a 60-minute chart between 72 and 70.75. There's a level higher up around about $72.98, $73. There's an opportunity for a break out of the range and then a surge towards the upside. Classic range break trade. So you're looking for a clue to get into this. From a shorter time frame perspective, you've got a lower high just in here at 71.80. Now, that may not be enough to give you a break, but when you see delta rising as you break that level, all of a sudden, you're seeing a change. you're seeing buyers take control. And this is the bit that says to you, right, you can buy it down here, 71.80, you can buy it up here on the break of 72. And so what ends up happening is the move between 71.80 and 72, this initial move here, gives you a very clear increase in delta. Volume does jump up, so relatively you're getting that increase in volume that you're after. Delta increases, so all of these things are good. But just from a volume perspective, volume increases and then very quickly falls here. Volume starts to fall away at the level at the top of the range. This would be an indication that perhaps this isn't the move that you really want. But the fact that as this happens, through these few candles that consolidate, delta continues to rise. Steadily ticks up and ticks up and ticks up. This would be different. What's happening here then is that at the top of range, where typically you would expect to run out of buyers logically for a higher range, you're actually seeing buying increasing. Buyers are continuing to hit. This is a sign that the break is on. This is the initiative that you're looking for. So as the delta rises, this moves alive. And so you can look at this, as we talked about with execution zones, anything between 71.80 and 72 is a chance to buy. And is now a chance to play for the sort of 72.98 type area. You end up with the continuation move up, the spike in volume that comes at the top of the move, and that produces the end of the move. Of course, the spike in volume doesn't produce the end of the move on its own. The spike in volume after you see the pullback is an indication that this move perhaps has finished, because volume then starts to fall back down. Delta flattens off as well, at or near the level, good indication the move could be over. But what you're looking for is it's the preemptive nature here. You already know that you're looking for the breakout. You already know what you want to see for the break. You want to see a drive through 71.80 that gives you the opportunity to buy at around 72 for the continuation up. That's what we're after. The increase in delta is the bit that confirms this for you. The bit that says this isn't just a drift up and potential fallback. This is initiative being taken. This is the drive higher. That is the opportunity then for that break towards the upside. That's the bit that you're after. Similar scenario. Looking for a break then on your 60-minute, and it's so often, I talked about this with chart patterns, you're looking generally at a larger time frame structure and using a shorter time frame execution. So again, you've got here a 60-minute chart on the left and a 5-minute chart on the right. This is your execution time frame. There's your trade. The trade here is quite simply to break the previous day's high, looking for continuation up. So there's your previous day's high at around about 158.55. So that comes in around here. That's what you're after. You're looking for that break. Now, of course, take away volume, take away delta. You know what to do here. You can buy as we go through the level. Simple. But what you want is you want conviction. You want something that says this time it is going to work. This time you can hit it with more size. This time you can be very confident that this is going to happen. So it's about differentiating trades. It's not about trying to take this on every time that you get this set up. Because if you don't get the delta with it, you don't get that aggression of buyers, there's no trade. And you need to be able to differentiate and step away from the trades that have no opportunity, trade the ones that do. So you start to see delta increase, and delta increases here on this candle ahead of 55. That's the bit that you're after. Now you have choices. In seeing delta rise before you reach 55, you can buy ahead of the level. You can buy, seeing the order flow coming in, seeing that pace on the ladder, think, yep, I'm going to buy this, buy it through the level. Or you wait for it to get to the level. As soon as you tick over the level, there's your opportunity to buy. You know what you're already looking for. You're looking for this move towards the upside. You've got targets pre-established. That's the bit that you're after. So it's about using that delta to preempt it, to say to yourself, yeah, this is the chance. And you can go for it there. That's what you're after on these types of movements. And that's where deltas are going to help you out in terms of preempting and confirming a move, showing that initiative that you're after. To illustrate this a little bit further, what we're going to look at now is initiative that does not sustain. So a little bit like a volume increase. If you don't see that volume increase sustained, then it's irrelevant. It's kind of a show that somebody was active, somebody had something to do, and now there's no follow through. Nobody else has anything to do. What you need is you need to see volume increase, you need to see delta increase. When you get those things, then the move is on. Without that, it's not. And this is all about expectation. And asking yourself, does the move match the expectation? Similar type concept, you're looking at a break of range. Now what we get on the break of range, these two arrows, is you get pace come in, you get a volume increase, you get delta jump. This is good. This is what you're after. But you get no follow through on this. So how do you go about actually taking this trade on? Because the delta will be enough to get you into the trade. The increase in delta, the break of the level, is sufficient to get you in. So the inability of delta to continue to rise and the very quick jump and reversal in delta that you get here is a worry. It's something that says to you, this isn't what I expect. This doesn't look right. Now, you have to balance this against, you've broken the range. You've got beyond the point where you want to be in, and the market's not back below that. So if you take it on this first trade, on the first arrow there, there's not a great deal going wrong. And you can then look at that and say to yourself, okay, well, I don't like it. It's not matching the expectation, but ultimately I'm not wrong. What you're then looking for is you're looking for further information. At this point, if we fall back into range, you're going to have to give the trade up. You've already got a situation where it doesn't look great and now it's falling back into range. This trade is dead. Alternately, you're waiting to see, can you break the current highs? If you can break the high, bring in more volume, bring in more delta. This is now the initiative coming in a little bit later, a delay. And that would be acceptable to stay in the trade. So whilst it's not looking ideal, you're still in with a chance. When you get the second break, which shows another spike in delta, lower volume, and again, an instant drop back, this is now making you very much doubt the trade. And as soon as you fall back below this previous high, the clues are starting to come. Twice now, it has defied your expectations. Your expectation is on a break of range, you're going to see delta increase, volume increase, the move drive towards the upside. It doesn't happen. So now you have a choice. You could potentially get out before it comes back to a scratch even, or certainly if it falls back into range very much, this is not a move that is on. That's the way that you want to be trying to look at it, that there's an expectation of what should happen. And as I've talked about before, you can't go into a trade thinking, oh, it might do this, it might do that, and I'm going to react one way or another. You've got to go into this thinking, right, if we break the range, I'm expecting this, this, and this to happen, volume increase, pace of book to increase, delta to increase, price to continue to move up. When that happens, initially, it's good enough to get in. It stops happening, and that can make you doubt the move, but it doesn't change the fact that you're out of the range. Move still on. When you get that a second time, and a failure to sustain above this high, all of a sudden, things are completely changing. This information is significant now. You've seen this twice. Volumes fall off at a point where you would ideally be looking for them to increase. Delta, once again, shows a spike and a lack of continuation. This move is dead. And that's where you can then start to get out because it doesn't match expectation. What we then get is the counter situation, where in fact this time, on a breakdown from the range, you again get no continuation of delta to the downside, and in fact it barely changes, and we then start to see delta rising back up as soon as you come back into the range. All of a sudden now, this is saying to you, this is a break that's on. Technically, you've got the slingshot type idea from a candlestick perspective. You're seeing volume starting to rise. You're seeing delta steadily progressing within the range. This has got all the hallmarks of a breakout. So now, whilst it's not worked over here, and this would be a situation where you are naturally going to be slightly nervous about taking the trade on, the information you have is different. That's key. You do have what you were looking for over here. You do have the rising delta, the rising volume, a market that gets to the highs and continues to show rising delta. This is what you're after, and this gives you the break that you're after. Gives you the drive up, gives you the spike of volume to complete the move up here. Whoops, too many drawings. Gives you the spike of volume up here. Failure to continue, delta starts to drop, the move is over. So that's the difference between an initiative that fails and the initiative that continues. And it's so much about matching your expectations to the reality. Go into it knowing what you want to see here, because once you get that, then you can be confident. You can take this trade on, but you don't want to be sitting in that when it clearly gives you a second indication that this isn't not what you're after. Whereas here, it never really says to you get out. And this is ideal. A move where you get the delta rise and saying to you stay in, stay in, stay in. There's no reason to get out of this trade. That's what your expectation is. That doesn't do it. You don't have to participate, or you at least can give that up reasonably quickly because it doesn't do what you expect it to do. Okay, delta acceleration then. This is something where you get this very significant change in people's perspective, change in the way people are trading. Now, I talked about this in terms of volume, where you would see volume increase within a range. Now, volume doesn't necessarily have to increase to indicate that a move is about to happen. Delta can show you this. So what we've got here is a trade in the S&P. What we see in this trade, we're looking for this break towards the upside, up here. It's a directional move up, above 46.50. Now, as you get towards the highs, volume doesn't really change in here. So you look at this pale blue highlight, you're up at the level, up at around about 46.50. Volume doesn't massively change, stays around about the levels that we've previously been at. But what happens on this candle is that delta increases by about 5,000. Now, like with volume, if you watch any market, you'll get an understanding of what's a significant amount. S&P increase in delta by about 5,000 is quite significant. You're rarely going to see delta on the day, so total cumulative delta in the S&P, you'll rarely see that above 50,000. So effectively 10% of the day's delta has been done on this one candle, but volume hasn't really changed. So what this is telling you is of that volume, a huge amount of it, a large proportion, 25% has been hit at market, or 25% more has been hit at market. This is very significant. You're seeing this huge change compared to anything else that we've seen. And this is the bit that's saying to you, this is the break, this is on now, because of the fact that you've got that huge increase in delta down there. It's what I call a delta punch. So you don't necessarily see the volume increase, but that huge shift, the swing all towards the buyers is what says to you, this is on now. That's the bit where you can take that information and say, yeah, I can take this on. Even though volume's not shifting, this move is very much on. And it gives you the continuation movement. That's the bit that you're after, is that delta punch that gets you out of that range, that says, yes, now you can take this trade on. So look out for these types of things. Your sort of delta acceleration, that moment of shift. And without a delta indicator, you're not going to see that. From a volume perspective, this looks like any other candle. It's not a particularly big candle either. It's just purely one of the other candles. But that bit of information that you've got from delta there is saying to you, yeah, this is very much on. Buyers really want to buy this. And sellers, to create the positive 5,000 delta, sellers have had to stand in the way. They've had to sit there and reload, and buyers have come in and bought and bought and bought and bought. And eventually they've overwhelmed the sellers. So the break of that level is then the point where this can go towards the upside, because sellers have put in a good defense, they've been defeated, the move is now very much on. That's the significance of that delta acceleration there. You're already seeing it moving up. So you're already getting a bit of clue that buyers fancy this, for want of a better word. They like the idea of this move. But when you get that punch that you see there, that's the bit that says this is very much on. Okay, so we looked at a few instances of using your delta on a short time frame to initiate trade, to confirm trade, to preempt a trade. What we're going to have a look at now then is viewing it from a longer time frame perspective. Each of the previous examples we brought down onto a kind of execution, 1 minute, 5 minute time frame. What we're going to do now is look at things from a slightly larger time frame and looking at how delta changing. So what I've got in a simple diagram here, top of the diagram is price, and bottom of the diagram is delta. So that's what we're seeing here. What's significant is going to be context. As with every iteration of a trade, every situation that comes up, context is key. And what's happening to create this is what really matters. So what we're going to have a little look at is, on the left-hand side, the concept of a delta unwind. And on the right-hand side, delta positioning, which could also to a degree be an unwind if you got a counter direction move. So we'll come on to this in a moment. But looking at the kind of stages of a delta unwind, and I'll give you a couple of examples of these in a moment. What ends up happening is positions will accumulate on a move lower. Sellers become more active, and this is then what drives delta down on this move lower. What you then end up with is, in the consolidation period, you get delta flattening off. So people will have accumulated positions. And now you're in a situation where these positions are, there's a net flat increase in positions. So delta has fallen, you've got people positioned, and that's the implication of delta falling, that sellers have taken control, driven this, active sellers are positioned short now. Of course, you have passive buyers who could be sitting there, and yeah, of course, there are now people long. Equally though, there are shorts who are now out because they've been putting their bids in to get out of their trades. But the implication is it's the sellers that took control here, so you can assume then that the market is generally positioned short. Delta flattens off, so no change here. But you know that you've got more short positioning now. This is susceptible. This is now vulnerable to a reversal. What are shorts looking for here? Well, they've been selling it. They're looking for this, for that next leg down. And if they don't get it, coming out of the consolidation, the block reversal, the downward sloping wedge, whatever it is, they could get forced out of this trade. So you now see how people could unwind positions. And all of this delta, whatever this number is here, is effectively what needs to be reversed, what needs to be unwound as you move out of that area. And that's what's going to give you this drive towards the upside. This is going to give you a more liquidation type move. So you're looking for a fast move here, and we'll talk more and more about liquidation, trying to distinguish between different types of movement. But what you're after here is a fast move to the upside, market accelerating as we go up, as these people get forced out of trades. You're not going to have too many sellers here. Sellers are already in, and sellers are looking for continuation. Once we start to reverse, those sellers are now looking to get out, a bit like a delta reversal. But you can see this over the course of days, building and building and building up. So the alternative is delta positioning, and this is a scenario where market is giving you a clue to something before it's happened. So what we have here is sideways market, range bound market. Within this, you've got quite a clear, quite distinct increase in delta, for example. So what this is showing you is actually buyers are more convinced here. Sellers are happy to sit at the top of the range and sell. They're going to sit there. Anybody comes in to buy, they sit passively and they prevent that from happening. But sellers are showing very little by way of aggression, active trade, as the market starts to come off, hence why delta continues to rise. So what this would imply is that the only real way that this market is going to go down is if sellers can get enough selling to then cause the buyers to unwind. The fact that this is currently not happening is a clue towards a move towards the upside. And so you can look at this, the fact that you're increasing delta in a range, building up people positioning for the break up. And you can now look for, once the passive selling towards the top of the range steps out of the way, that buying is now going to continue. These buyers may well not be done. And that's fine when they're in the range because they can continue to buy in this zone here. But now you have the possibility that they're going to become more active, and you get continuation of this as you get this drive towards the upside. So it gives you a preemptive clue over a longer time period rather than just the execution time frame. It allows you to bias yourself over the next day or two, looking for the continuation of movement from that perspective. Okay, let's have a little look at an example. And what we're looking at here then is delta increasing within range. So you have these couple of days in here, delta increasing just in here. Delta drops and bounces back. Very distinct increase in delta on the day. This is Euro stocks. Typically, extremes of delta for Euro stocks run to around about 30,000. Around about how much you'd expect to see. So we get one day that gives you positive delta after a reversal. Next day gives you around about 30,000 in delta. Next day, very, very early on in the day, excuse me for the drawings, very early on in the day, you're already touching up towards 30,000 in delta up here. That comes in down here. This is giving you an indication that you're starting to see buying strength in the range. It's the buyers that are in control now. So you can start looking at this thinking, okay, good. I can now start to be biased towards the upside. You can now start to play this as the move comes. But also, once you get a gap up, your view is continuing this move, to continue to look for this drive higher, looking for whatever reference points you have, perhaps these highs. You then get a further gap above that as well. Shows a clear, strong move. And so whilst this isn't going to allow you to execute, to be able to say, right, I'm going to get in there, I'm going to get in precisely here, or time it in a certain way, what it allows you to do is lean towards the perhaps more likely scenario. That's what you're after. So you can lean towards that, you're leaning towards the upside here, you're leaning towards the upside here, and as long as delta continues, as it does on these couple of days, there is very little reason to want to give this trade up, or at least want to give that bias up. Like I say, from a day trading perspective, not expecting people to get in down here and hold this day after day after day, but you're looking to try and give yourself a guidance on the day. And your guidance here from the delta perspective is that added to the fact that you've had a move lower, followed by a kind of consolidation and break higher, added to that is a good indication that this move can continue. We get the breakaway gap, as we've talked about previously. You get potentially an exhaustion gap. Of course, you don't know at this point. You get breakaway gap, possibly a further breakaway gap as you break previous highs. Can we see a move continuing? And this is what happens, the continuation of that movement. This is where we were just up to. There's that potential breakaway gap. And on the back of that, delta continues to rise. Move is still on. Delta continues to rise. Move is still on. So it maintains this bias. What you're able to then do, as you start seeing in this blue box at the top, delta now starts to fall. Now that doesn't mean that this is about to collapse, that the move's over. But what it should be doing for you is getting you thinking, well, we've had delta rising from all the way back here. So for around about a week, every day delta's risen. That's quite a significant amount of buying. And now you're starting to see it fall. This is a good indication, if nothing else, to move to a more neutral view. Potentially this is your exhaustion gap. But until you start trading back through it, it's still a gap and it's still holding this move higher. But it could well be the sign of exhaustion. The fact that delta is now starting to fall as well is a further illustration of that, or a further kind of clue that that may well be the case. So you can move your bias now to a more neutral stance. You could see here, after this little balancing out, delta falls as some of the buyers in here start to profit take, they start to sell. Some sellers now decide that, yeah, now could well be the time to sell. You get some more aggressive selling. You can become neutral. We could continue. We could fall. And you're now going to have to move onwards to the next phase of the move to assess which of those it's going to be. Again, you can now start to assess things from a delta perspective, from a volume perspective, and make your choices. So it's about giving yourself a bias over time, about giving yourself a guidance as to what could happen, rather than being able to say, yeah, delta on its own is giving me a trade. From a short time frame perspective, that can. What we've got here then is, again, this delta positioning, this clue. We've got a scenario where you have a gap liquidation move. We talked about these liquidation gaps previously. But what you're getting is preemptive selling up here. This day, so this again is on an hourly perspective, or an hourly time frame, huge negative delta, massive sell-off. So delta's dropping significantly. So what this is showing you is that sellers are very much in control on this day. And if you look at the day's shape, it's essentially a day that goes up and comes back. The fact that it's not out of the range isn't massively bearish in terms of chart pattern, but it's a day that fails to go towards the upside. But where does the delta drop? The delta drops from here. So all throughout that bit of the move, delta is falling heavily. Sellers are taking control here. Now, that doesn't necessarily lead to anything, but what it's showing you is sellers have now concluded this is the time to start selling. So this gives you a lot of information. You know that there are passive longs who have been filled here. For this selling to take place, somebody's got to stand there and get filled. So there are people who are now long up here, all in this zone. Now, they're not wrong necessarily. And if we look at what's happened on the previous couple of weeks, anywhere in this range, you're seeing a market that is rotating up and down. You're not wrong if you're long up here from a 2-3 week perspective. Not at least until you get below the bottom of the range. Once that happens, now all of these people are wrong. And you know that there's built up a significant amount of passive longs in here. Sellers have taken control. Equally, the sellers that are in control up here, or the sellers that tried to take control, if their intent was to continue selling, well, now they're forced to sell. Because if they don't sell at the bottom of the range, it may well be that they don't get the chance to sell and this market can run away from them. As it does, you get the gap, the liquidation type move, very, very fast move towards the downside. And this was, given to you as a clue. In no way does the drop in delta suggest that you must have a gap. In no way does it indicate that. This is a gap created by a bit of news or a correlated market move lower. So the negative delta can't tell you that. But what the negative delta can tell you is that there are people positioned long up here, and there are also people who were happy to sell up there and may well still want to sell. They're running out of opportunity to sell. And the break of that range is now where they're going to get forced to come in that little bit faster. And that's what gives you that gap liquidation type movement. Here's another example of this. Very similar type thing that comes over 3 days now rather than just over the one. This is one that comes up in the S&P. Sideways range, very clear reference point at 67.5. Multiple tests down of lows. So a similar kind of structure. It's not a gap liquidation trade, but you can see the kind of idea here that you're seeing selling throughout this move, this move, this move. People positioning themselves short. Buyers continue to come in. Where are buyers continuing to come in? Well, chances are they're coming in around this level at 67.5. So now, not only do you have a level that has been tested multiple times, and from the simple technical perspective, this implies a level that is breakable. But you also now have a level that you know there is likely to be a large amount of passive longs at, because they have all been filled. And in giving you that, this is the S&P, we get to around about minus 50,000 at the peak of this drop here, around about 30,000 here, and around about 25,000 down there. Significant amount of selling. You come in the next day, Delta starts to drop as the move approaches the level. So now, if you brought this onto a short time frame, you may well get that point where you get Delta increase, the acceleration in Delta, that punch to give you that move through. You're not going to get a Delta divergence there. You're looking for that Delta driving lower, price approaches the level. As long as that Delta is continuing to fall, you've got the chance to get in, and you can understand why that break's coming, because people are positioned for the break. Right then, Delta unwinds. This is a situation where positions get built up. And of course, like we just looked at, rising Delta isn't an indication the market must fall over. So it has to always be considered in context, and you have to look at this and say, so, okay, right, well, we're seeing this steady move up. Delta continues to steadily rise, and people continue to add. If you look here, once you start moving into this phase, continuation higher, and we start to then pull back, Delta doesn't fall. People don't start to exit the trade as the price moves lower. So yes, it flattens off, but people aren't getting out. People are maintaining their positions, and that's fine. Technically, that makes sense. That as long as you're staying above the previous day's high, as long as you're staying above this level here, this is around about 46, just here, excuse me, this little blue box, there's no real reason to get out of trade. So you're okay. So no reason to exit the trade. But knowing that you have increased Delta, knowing that people have got themselves long and they're happy to weather the pullback, if you then start to see Delta changing very quickly, this is where the unwind comes from. What we end up with here then is steady move up. We talk about bad highs a little bit more when we get profile, but what you're seeing there is a market that continually trades the same high. People are going to be looking at that, expecting that to break, and that's partly why positions are maintained on a pullback. But you get this pullback, market then starts to bounce, and you see Delta rises as we get this bounce up. So people are very much still willing to buy. And then what you get is the break back into the previous day's range. And as soon as you get that, and you get this Delta punch down and volume increases, this is where you get the fast drop, the liquidation type move. So it's not to say that every rise in Delta naturally leads to an unwind, or every fall in Delta leads to an unwind, but it's susceptible to it. And partly when coupled with a certain type of movement, these grinding moves that steadily progress, steadily tick towards the upside without really any drive higher. It's just continually people steadily hitting through the offers. Are generally moves that then, when the market falls back down or starts to reverse, don't have a great deal of support in them because the market is ground up. So it's these grinding moves, rising Delta, susceptible then to that unwind type situation. This is on a short time frame. This is looking on a 5-minute chart, the move up and then the fast reversal. But you can take this onto an hourly time frame and look at something like this, where you have the move down and then you get this steady continuation down. Delta's dropped in here, so you got the Delta drive down, Delta falls again, these two here, and Delta then starts to sort of flatten off, but still generally progresses down. You then presented with a head and shoulders type pattern, a situation where as well, on this little move down here, you don't get the market holding into this range. So you're seeing this build up of Delta towards the downside. We're moving again into this kind of concept over a couple of days here, a little bit like a Delta reversal. You don't have that Delta divergence. And this is why I call it Delta unwind. You're still seeing continued drop in Delta that flattens off, move stagnates. That flattening off of Delta now makes these shorts in here and the few shorts that have accumulated in here vulnerable. So technically, the head and shoulders break towards the upside looks good. And when you start to see Delta rising here, you start getting Delta ticking up in this zone, this is now the point where you think, yeah, the break is on. The unwind of these shorts in here is what's going to give me that drive towards the upside. So that's the concept behind a Delta unwind. And people get themselves positioned one way, they're looking for continuation, they're waiting for that continuation. When they don't get it, they're going to have to unwind that trade. And it's something that can build up over a few days. And this is the difference and the reason for bringing this kind of concept in. It's allowing you to sit through this and see, well, okay, not a great deal is changing. The market is stable, isn't doing a great deal, but you know that it's vulnerable now to that reverse. If it starts to show signs of it on any day, and it doesn't have to happen on this day, it can be the next one and the next one. If it starts to show those signs, that's where then that larger reversal can then start to come in. So don't just track delta as a method to get into a trade. Track delta also as a method to assess positioning over time and understand how people have got themselves directionally biased and how you can then change your bias accordingly and sort of lean yourself towards certain potential movements. Right, so to give a quick summary of volume and of delta. With volume, it's not just simply about qualifying a move. That's the ultimate intent of volume. The volume is there to qualify a move, to give a move strength, to look at two moves the same, be able to say, okay, this one with higher volume is much more important than this. But it's to manage expectations as well. Periods of low volume potentially don't suit you. Periods of low volume suggest that trade opportunities are limited. And as you start seeing volume increasing above average or increasing above what we've recently been seeing, this is now the chance to start expecting more, to start looking for range expansion, to start looking for more and more opportunities as that volume increase partly as an indication of volatility increase as well. It allows you to know when you should be involved. And this is something that you need to do for yourselves. You need to sit down and ask yourself, right, when do I need to be involved? Do quiet, slow markets suit me? Do high volatility, fast moving markets suit me? What kind of volume is ideal for myself on a 1 minute or a 5 minute time frame? This gives you a great filter on the day. You can't expand that too far, 15 minutes, hours, because by the time you've worked out whether this is a day that suits you, the day's almost over. So you're going to be looking at it from perhaps a 5 minute perspective, 1 minute perspective. This way you get a good sense as to when you're better at trading. And one of the best things when you start off trading is just trying to work out when you should and shouldn't be trading, because the temptation is always to be trading, and that's never usually going to be a good outcome. You have to think of things in context. Volume can't be viewed as an absolute. You have to view volume in terms of where you are, what the implication of an increase in volume in this situation is versus this. Is that increase in volume after a directional move an indication of a continuation of movement, or is it a very sudden increase after steady volume that is now an indication of the exhaustion of movement? So make sure you think about it from that perspective. Are you seeing initiative? Are you seeing exhaustion? Are you seeing manipulation? Are you seeing volume generally falling off, which is indicating the end of movement and the potential of reversal? Remember, volume is only going to give you potential, just like delta. They give you potential, they enhance your understanding of what's going on, but in no way can they say now is the time to take the trade on. What delta does is it gives you a greater insight. It gives you a deeper understanding of how that volume is being created. Is it aggressive buying? Is it aggressive selling? What are the passive positions doing? At what point are those passive positions going to be overcome? And what's then your expected move once they're overcome? So delta rising within a range is showing that people are building up passive short positions. What happens when you break out of range? Are they going to be forced out? How do you expect that move to then develop? So it allows you to see strength before a move. It allows you to build up a sense of positioning over time, so that you're not just simply looking at a market from the perspective of waiting for the delta to say, now you can take this short-term trade on, but you're giving yourself a bias. You're sort of building up the story. It's not just purely candlesticks now. It's candlesticks that have got volume with it. They've got delta that can start to show you how people are getting themselves positioned. Volume on a day can't give you much of an indication of positioning, but delta rising or falling can. That's how it gives you that greater qualification of what the delta is showing you. Remember, with all of these, and perhaps the most important thing, access is crucial. If you can't define a point to get into the trade, you can't define where you can get in and where you need to put your stop, where you're looking to go with this trade, you can't take it on. It's as simple as that. So whilst these things give you an idea and say, yeah, maybe this trade's on, access, without that, you can't take a trade on. So make sure you have access. That's the crucial thing. We'll wrap it up there on volume and delta. Think these things through. Start to investigate for yourself what the ideal trading situations are for you. Also, have a look at delta. Watch whatever markets it is that you're trading. Look at delta and see what is a significant amount of delta for certain markets. I gave you examples. S&P, you're rarely going to see over 50,000 positive or negative delta. Something like the DAX, you're rarely going to see over 2,000. Oil is perhaps somewhere more around about 5,000. as a limit, 5 to 7,000. So give yourself a sense, like with those volume distributions or profile throughout the day, have a sense as to what is a kind of extreme, what is a generally expected flow of volume throughout the day, what's a sort of limit of delta throughout the day. So you become more aware of the information that you're getting. I'll wrap it up there and we'll go and look at entries and exits.